Hello and welcome to another exciting episode of Eye on the Money, the television show that gives you insights into how to improve your financial well-being as well as make your money work for you. I'm Ingrid Nantege. On today's show, we discuss debt management during the COVID-19 period. Now, non-performing loan portfolios in the country have been on an upward trend due to the general economic slowdown, which has persisted since the 2017 election cycle. The end of 2019 financial year saw that total NPLs hit 13.1%, up from 12.5% at the end of 2019. In light of the COVID-19 pandemic, the Central Bank of Kenya issued a directive ordering banks to restructure loans for their customers at their own cost, in a move that was aimed at offering relief to distressed customers in the face of the pandemic. The move saw banks restructure loans worth 1.12 trillion, or 38% of the total loan book by the end of August. According to a survey done by CollectPro and Sandbox Community, personal and household loans topped the list of restructured loans, with 271 billion shillings reviewed since March, or a third of the total loans whose terms have been changed. The survey further shows that when asked about their state of loan repayments since the beginning of the pandemic, 10% of the respondents expressed non-payment, 13.6% stated that they are significantly behind on their payments, while 24.9% confessed to being slightly behind. Joining me on the show today to discuss debt management, particularly now during the COVID-19 period, is Timothy Gathima, credit expert at the Sandbox. Welcome to the show, Timothy.
Hi Ingrid, how are you doing?
Very well, how are you? So when we talk about this issue of debt management, and particularly to make reference to the survey that was done by CollectPro together with the Sandbox Community that aimed to look at, the impact of COVID-19 on people's ability to repay their loans, what would you say were the findings of the survey, and what sort of impacts have we seen the pandemic have on people's finances?
Okay, so the interesting thing about the findings is that there are positive and there are negative findings. And on the positive side, which, in a sense was anticipated, was that 5% of the people were able to increase the amounts that they were paying in the loan repayments. And particularly, you can see this is because for the people who have full-time jobs and, have been getting regular income, they had a reduction in their monthly expenses. So you're no longer commuting, so you're no longer either going by matatu or, paying for fuel. And some of the people who are able to, to get these gains now push the money towards their loan repayment. On the other hand, you have the people who are in industries or in companies that have been affected by the pandemic. So you're talking about people in education sector, people in just general business, because the lockdown affected businesses, people in hospitality, restaurants, hotels, that kind of a thing. People whose incomes were directly affected by the pandemic were largely the people who you could see either stopped making payments altogether, were unable to pay their loans, or had to reduce the amounts of loans that they were paying, either because their businesses were suffering, or that they as employees had to either take salary cuts or they lost their jobs. So it was a double-edged. But then also we have, 1/3 of the respondents who said, well, there's been no effect. We are still paying as our payments are still on point.
So with that said, and I would like to actually focus on now the people who are in the negative part, who are affected. What would you say are the implications of the failure to pay these loans? What does this mean, particularly at a time like this? Okay,
so one of the lucky things that that the government did to try and help individuals was they put a stop to listing of people at the CRBs. And so if you fell behind during the COVID period, so this doesn't affect the people who had been listed before. It was talking about the new listings from I think it's from March. So if you did fall behind, what it did was it gave you like a breather. So you have a pause where over this period of time, if you are unable to pay, there'll be no negative consequence of being listed. So that doesn't mean that there won't be other negative consequences. What it means that specifically, as far as listing with the CRBs is concerned, you will not be listed up to the 1st of October. So from the 1st of October now, if you do not make your payments, the rules basically are if you don't make payments for 90 days, then you get listed. So you have between now and the end of December to, to continue with your payments and make sure you don't become what is called a non-performing loan. Yep.
So Timothy, with that said, and we're seeing a situation also where some of the measures that the government put in place to buffer individuals are lapsing or coming to an end. I mean, you've mentioned December, the moratorium on like loan repayment for banks expired in October. Where then does this leave individuals, and where are the options for individuals at a time where they've failed to pay their loans, things are getting back to normal, they no longer have any more relief? What next now?
Okay, so you need to, first of all, evaluate where you're at as an individual or as a business, as an SME, as an employee. You need to look at your finances, look at what is coming in and what is going out. If you've taken a hit in your incomes, you need to adjust your expenses accordingly. So you need to, if it means downgrading your life, if it means selling assets which you can to be able to get some cash flows in, you need to do, first of all, have that brutal, very honest examination of yourself or your business. Once you've been able to see where the cash flows lie, the next thing I tell you to do is go talk to the person you've borrowed from. So if it's your bank, talk to your relationship manager. That communication, I think, is the most important thing when it comes to managing your debt. Whether it's as a business, whether it's as an individual, communication is the most important thing. Why is that? Okay, so for me, as I sit on this side as somebody who advises individuals and companies on managing their debt, and I help them with collecting their debt, then I'm able to examine the different options. We're able to negotiate, we're able to write off, we're able to come to a different agreement. But where there's no communication, then we're left with one option, and that option is to escalate. So at that point, I'll probably be looking at going through the legal process so that I can be able to get the courts to help me get my money back, or to help my client get their money back. But when we do communicate, then we're able to look at different options. And most of the times, we say, hatuwezi kosana, as far as money is concerned,
Right.
You will come to a compromise. So that's the second thing. And then the third thing, and the most important thing, is start making payments. So there's no, people say the cure of debt is payment. Malipo ya deni ni kulipa. So, dawa ya deni ni kulipa.
Right.
So that's as basic and fundamental as it is, that's it. Get into a routine of making monthly payments. I know a lot of us get caught up in this thing of, I'm waiting for this big lump sum so that I can pay all my arrears. That never works. It might work 1% of the time, but 99% of the time, what works is making monthly payments. That habit of constantly making a payment, even if it's below what you had agreed to, the most important thing is, whether you owe 1 million, 1 billion, 10 million, whatever it is,
Just
make
pay.
a monthly payment. Just pay and pay. And that's why when you do the fast evaluation of yourself, you'll be able to see how much you can afford to pay as a minimum every single month. Then from there, you can be able to start building up. You'll have unexpected money coming in, you can divert it towards your loan repayment. So those are the three things which for me are very important.
Timothy, my next question is almost linked to what you've just said. I mean, oftentimes we'll hear people say, "Oh, money is not enough." In fact, there's even a saying where they'll say the only person without, debt is someone in a cemetery. So people somehow justify the need to take on debt by saying, I mean, my needs obviously outweigh how much I have. Like, there's no point in time where my money will outweigh my needs. So my question then is, when it comes to debt management, even though it's even just talking about staying out of debt, what are the most important factors that people need to consider? Because again, from your survey, it shows that a lot of the loans that were restructured were, towards personal or household. So people would argue, is that really, really where, people should be taking out debt? Or, what would be your take on factors to consider when it comes to debt management, and how can people actually even stay out of debt?
Okay, so in a perfect world, perfect world, nobody would have debt, but we
Right.
don't have a perfect world. We have shortfalls in terms of our income against what we want to expend. So on a personal, when you're dealing with debt as an individual on a personal basis, you need to borrow. If you're borrowing, borrow for things which are going to return some sort of income, or borrow for things which you do not have. For example, okay, let's say you're working in a job, and your job requires you to travel a lot by car, and possibly you get mileage or whatever it is. So getting a loan to buy a car at that point in time makes sense because it's helping you do your job. However, if you're just buying a car and you don't need one, you're just buying a car because you want to have something to show off to your friends for the weekend, then you're better off possibly saving for that and not taking a loan to buy that vehicle. So, as an individual and even as companies, where you're borrowing, and or rather what you're borrowing for, is the most important. Borrow to make money out of what it is you're borrowing. The second thing is, look at the cost of the loan. So you want to build a relationship or a reputation with your lending institution. Whether your lending institution is your bank, whether your lending institution is your SACCO, you want to get to the point where you have the ability to borrow, because those institutions will probably give you the best rates that you can get, even if you're borrowing from friends and family. Because one of the things that we realized when we're doing the survey is that friends and family are actually a big source of borrowing. And again, you still want to build a reputation with them. You want them to know that if they lend you money, you can pay it back. So a lot of people, a lot of small companies are built, with borrowings from friends and family. Always look for the cheap source of income, and be faithful in terms of how you manage your repayments to that source of income. So your reputation as a repaying, as somebody who's good for the borrowing is very important.
Timothy,
Yeah.
again, within this pandemic period, we've seen the alarming figures on job losses, on businesses that have closed shop. In fact, we've even seen situations where businesses or people have been have been on the verge, with some of them even actually going as far as filing for bankruptcy. I'd like to hear your thoughts on that. Is it even a viable move? How does it work? What would you have to say within that line?
Okay, filing for bankruptcy is an important protection that individuals and companies are given by the law, so that you can have time to be able to to reset and recover. There are implications when you file for bankruptcy. You will be listed at the CRBs for 7 years, and it will forever show that at some point in your life you are unable to make your payments completely. But I think it's important, especially for businesses, it's important to know when it's time to walk away. We always sing the song we always know, that song for Kenny Roger, where we're like, you have to know when to hold them, you have to
Right.
know, you have to know when to walk away. And that's the thing about I've seen over and over again people who refuse to let go of a business for sentimental reasons, for whatever reason, because of pride. But at the end of the day, you end up taking so much what I call good money and throwing it after bad, trying to plug a hole of bad money. So you borrow from reliable sources, you sell your assets to try and keep a business alive, which really should not be kept alive. So again, talk to the right professionals. I think this cannot be, I can't say this enough. It's important to get the right advice from people who know what they're talking about. Have you talked to somebody, a financial advisor? Have you talked to an advocate? Have you talked to a strategy person? Talk to somebody who has dealt with many other businesses, because you cannot possibly know everything about everything, And if you think you do, there's a reason why you're in the position that you're in. So as a business, it's important to know at this point in time, it's no longer viable. Let's figure a way out. And in so doing, you'll be able to also avoid some of the things that come with, going completely bankrupt without having a plan. Because you can end up losing your personal assets. You could have built a beautiful family home, and this stuff goes. Your kids get kicked out of school. But if you're able to plan this well in advance, knowing what is coming, you'll be able to avoid certain things. Yeah.
Thank you very much. I'm going to take a very quick break at this point, Timothy, but don't go anywhere because I have actually more questions for you. With me in studio today on Eye on the Money, I have Timothy Gathima, who's talking to us about credit or rather debt management, particularly now during the COVID-19 pandemic that has taken a toll on almost everyone's finances. We'll go for a quick break, and you can be a part of the conversation by sending your feedback to our social media handles. We'll be right back.